This is a topic I've been thinking about for quite some time. I don't have a clear answer on it. I describe it as the public marketification of private markets. Is it a good thing? Is it a bad thing? To me, it seems like it's a double-edged sword. And let me just lay out what I mean by this. We invest in private companies, and naturally, you'd expect we want to know as much as we possibly can about what's happening with our businesses. But these are really early stage companies. The more we know, the more you can assume that information gets out to the broader market. And so what I've seen as a phenomenon is later stage investors can use that information to think about how to programmatically invest in early stage companies. Hey, what are their SaaS metrics? What's their gross dollar retention? And now my fear is when you do this, you end up managing these early stage companies to metrics that might not even be the right thing to manage them to at an early stage. And let me try to bring this to life with our own personal lives. If you have a child, especially in the United States, and you're trying to send them to good schools, more often than not, you're letting them play around, try to figure out who they're going to be when they get older. It's not until they get to like college where they start to specialize. And so you're giving them a lot of room to try to figure things out. And what I'm trying to understand is this public marketification of private markets, of these early stage companies, a good thing or a bad thing? Or are we preventing these companies from having enough space to play around to try to figure out what they're actually going to become? And they don't have the room to do so because right out of the gate, we're managing them to metrics that might not even be the right thing to manage.
So let me start by asking a question. And I'm going to channel my inner Andy, the philosopher on this call. When we say a good thing or a bad thing, what do we actually mean? What would be good or bad?
I think a bad thing would be you believe you identify that your kid can throw the ball really fast. And all of a sudden you're saying that kid's got to be a pitcher. And you put all this infrastructure and coaching and planning around this kid becoming a pitcher. And you never even have the opportunity to learn if your son's actually fast, could be a sprinter, or maybe hates pitching, and you destroy their, the career or the career that they never potentially had. And in the same way, I think about an early stage company. I think a lot of the businesses that we know start doing something and then they get managed to metrics and they have to perform month to month. And so they, in a lot of cases, they just keep doing the thing that they started doing when maybe that's not even the right thing to do. Because they're trying to act like these public companies that are measured quarter to quarter, and they shouldn't be, I guess is my thought. So they may miss the real opportunity of what they should become when they grow up, but we don't give them the opportunity to do so. Hopefully I'm explaining that somewhat clearly.
So I have a couple of thoughts about that. The first one is we often talk about them developing pro hygiene. And I think that's very different than um, holding them to metrics that are less than appropriate for growth and development and experimentation. So I would put that on one side of the equation. Have good financial hygiene, good go-to-market hygiene, et cetera, et cetera. The second thing is whether what we're really talking about here is if they are thinking big enough, experimenting enough, curious enough to continue to push forward. One of the complaints you always talk about is, hey, I onboarded this great platform and it was great for a year, but they didn't innovate. And after a while, it was a one-trick pony. So I think there's a balancing act between enforcing good hygiene and pushing them to be relentless, curious, experimental. It's just the first
I
thought.
couldn't agree more, Andy. I think I'm thinking about it more from like what's the benefits of the publication, in my opinion, is a public company has to do what they say they're going to do, and they have to continue to innovate to earn their multiples and grow their stock price. Those two things are non-negotiables for a public company. those are actually helpful to a software business in some ways to say, hey, if I say I'm going to do this, I'm going to actually do it, and I'm going to be held accountable to it. I think that's where you're seeing the rub a little bit is the accountability that was potentially missing during the ZERP era on both sides of the spectrum.
Ron, what's the ZERP era?
Sorry?
What is the ZERP era?
The ZERP era, this unlimited capital with zero accountability, probably from 2021 to 2023 would be my timeline. 2020.
Zero interest rate policy, right?
Guys.
Let me bring this to life in like two real stories. Andy, we ran the incubator at Colgate. Jake Danahy came to us and he said, I want to start a hot dog cart that sells hot dogs to kids coming out of the bar late at night who are drunk, and I'm going to make a lot of money. Well, it turns out Jake actually wanted to be having fun inside the bar. But we saw promise in Jake. And we said, come into the incubator. Sure. Our hunch is this idea sucks. It's not going to work out. Sure enough, that was the case. We weren't like, no, you got to figure out how to make the hot dog cart business work. We said, what else are you interested in? What else do you want to explore? Oh, I surfed on the shore of Southern Long Island my entire life. I'm an environmental studies major learning about plastics in the ocean. I saw it firsthand. It drives me crazy. There must be something I can do about this. And he kept pulling on that thread with his sister. And they now run a business called Fair Harbor that does tens of millions in sales a year, selling all sorts of apparel made by plastic, refuse plastic in the world. If we had just managed him to the hot dog cart metrics, how many hot dog carts did you host this week? I don't know. Would he have figured out, hey, this isn't what I should be doing. Maybe I should do something else. And we gave him a sandbox to explore.
But I think what we also did is we said, okay, you talk about pulling on threads, follow the line here of your hot dog cart business. Where does it lead? And it became pretty clear pretty fast that it led him to being outside the bar, freezing his butt off and not growing things very much.
But if I were to translate that into companies in our portfolio without naming names, we have some companies that we'd say things are not going all that well. Are we managing them to metrics on a business that might just not be the right business to be in for the sake of seeing what they can produce month to month on ARR, when the reality is what they should be doing is having a bit more of a sandbox to go play around and try to find another thread to pull on before they run out of cash and don't even get the option to do so?
Here's I think the answer to that, for early stage companies that haven't really found product market fit, I think most people would agree that the answer is yes. I think this question actually gets really tricky, and I'll give two examples. If we think about Amazon and where they started selling books, and then they went public, and imagine a world where Amazon didn't make AWS, where they didn't make Amazon Prime, where they didn't have Amazon Studio. And to be fair, I think Jeff Bezos probably had more conviction than the Wall Street analysts who would have said, why are you losing money? You should be producing a big dividend. And then even look at Facebook with their foray into virtual and augmented reality. Maybe that won't work. But these guys already have tremendously successful businesses, but they're asking the question, is this going to get stale? How do I keep growing and going forward? So I think ironically in the private, earlier stage, it's actually these companies that probably have moderate growth that are in the most dangerous position. How do you decide if you're, growing but sort of slow SaaS company where you're in a knife fight for each customer is the right solution, or if you should swing for the fences, but you might fail? I think these kind of sort of successful companies produce the biggest gray area. What do you guys think about those cases? Because we definitely have some of those in the portfolio, and it's kind of a good business, but do you want them to potentially kind of go for broke, or do you want to
or potentially end up in no man's land?
Yeah, but there's a really tough challenge we have as investors, because they may be, by the time we realize they're not doing as well as we'd like them to do, typically there's a shrinking pool of cash for them to invest in sandbox activities. The Facebooks, etc., Amazons, when they start experimenting, very often there's a good pool of experimental cash there. When we've got an early stage company that we're looking at that's got, 7 months of runway left, and we're torn. We want them to experiment. We want them to push the envelope, but we're also thinking, okay, if we want them to do that, then do we have to reach in our pocket again?
But
Do
what
we have sufficient?
it's not as or go for it, Ron.
I would challenge that. We've actually seen the inverse relationship. They have a lot of cash left, and they're not growing fast enough. That's what Charlie, I think, is alluding to, is no man's land. Is like tremendous runway, but no investment in growth or innovation, and the appetite for it because of the fact they're saying, hey, I need to conserve my cash, or I'm being held to certain cash balance metrics.
So let me play the devil's advocate. I'm the founder of that company, right? I still have 24 months of runway. Things are going okay. Maybe this is Charlie's concept of the middling business. You're managing me to all these metrics month to month, and you're kind of telling me you're not happy with how things are going. But are you also telling me go try some other stuff? Like, no, you're telling me to just get better and better at this thing, and maybe this is just not the right thing to be working on. Like, what should the investor be telling that company?
Well, I think you push them pretty relentlessly to experiment. The challenge is, and this is an irony when it comes to entrepreneurs, we always talk about entrepreneurs as risk takers. And I think one of the themes we've seen over the last 10 years is once the money is raised and there's a big pool of sleep at night capital, they become ironically conservative. I'm going to keep doing the same thing. Now I've got 2 years or 3 years of runway. And I think that's a very big challenge. It's a psychological challenge, or psychological emotional, for the founders who want that feeling of safety. So I don't know how to answer that one, but I think it's a theme we've definitely seen, and maybe a different species of entrepreneur.
I think Will's it's a really good. It reminds me of being up 2-0 in a soccer game. Like, you probably should win. You feel like you should win, but you're going to get conservative probably, and then something bad often happens. And to your point, I think one thing founders probably are scared of is, like, they think you're going to say that it's kind of a lose-lose for them. Either do everything you're doing but better, and if you don't, you've failed, or try something new. And, like, yes, we support you taking risks. Like, of course you should take risks, swing for the fences. But then if it doesn't work, it's not my fault. It's your fault. Anyways, it's like, okay, either way, the investor's a genius and the founder's a loser. And I think that's sort of, like, probably sincerely how a lot of founders feel. But to the actual underlying question, it's like, how do you decide? Andy kind of alluded to this before, that you're actually on a sufficiently high growth path versus, like, maybe we should switch. And then it gets even more tricky. Let's say you own 40% of your business and it has, $3 million of ARR, and it's growing, 25% a year, and you could sell it and get, $5 million yourself, or you could swing for the fences and maybe you'll make $50 million in a couple of years, but $5 million is not nothing. So there's all these, like, strange incentives. I guess I didn't answer it any more easily.
I would answer it, Will's, with, like, the job of investors used to be ideas, and founders were left holding the bag of prioritizing those ideas into actions. I think the shift has been made in exactly what you're talking about, in the privatization of
Public market.
publication of private markets, is that we are also need to help them with prioritizing what needs to come first. And
You think we're
probably have the same ideas.
You think
It's a
we're
matter
matter
of what we do first.
not just, there's this proliferation of SaaS metrics. Are we being lazy to just measure them by that and not, like,
Absolutely.
be more creative about how to analyze a business and what to measure?
Yeah, absolutely. I think a good example of that is monthly active users. It's a pretty lazy metric. The real thing is, how much of your functionality are they actually logging into? Like, if you have 10 features, are they logging into 7 out of 10 or 1 out of 10? 1 out of 10 gets you a monthly active user.
I just think back to I was running a company and I would get all these BD emails from associates at private equity firms, and they would have really specific criteria. Are you between this revenue floor and this revenue ceiling? Do you have 20% annual growth? Do you have this much, net logo retention? Is your gross margin above this? And I just was thinking to myself, like, that's just so prescriptive. Like, you're basically just, robotic, and maybe that works for later stage companies, but maybe this is just me being romantic, but how many of like the major innovations we've had historically would have been successful if from day one some guy like that in a Patagonia vest, no offense, Wills, but that's not a vest, that's actually a shirt, or a sweater, was just like, hey, I'm just pretty concerned about your current CAC to LTV ratio right now. You've only been doing this for a year and a half, but that's just not going to cut it. So I think part of the onus is on us as investors. If we want to say we support high risk, swinging for the fences, then we actually need to do that. And I think give founders permission to do it and not have amnesia and say, oh, you just did it poorly, but actually take some ownership for our own contribution and our own ideas.
Any parting thoughts, Ram, Andy?
Yeah, I think the VC world has, to some extent, particularly recently, been guilty of speaking out of two sides of its mouth. We want you to grow, 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 grow. By the way, did we mention we want you to be profitable?
Yeah.
Okay. Wait, is it A or B? And, the answer from the investors is yes.
Yeah, I would just add to that, like, there's definitely an optimization for speed when you get ideas at early stage businesses. Let me go run at this thing. I would say this is one of those things where you might want to slow down to speed up to understand what really the order is of the ask, and get organized. Make sure you're ready for it, so the metrics do show up, whatever you're going after.